Welcome once again to another futures video. I'd like to make note that futures can be used to help achieve some helpful and interesting results. I'm going to show you two examples. Example number one, let's assume that you're working for a company, you're a treasurer, and you're going to be needing to borrow money to fund a project sometime in the future, say 6 months, 12 months down the road. And you're looking at the markets and you see right now that interest rates look attractive. They're low, attractive from your perspective as a borrower. But you don't need the money now. You need the money later. And as time passes, the rates might change. So what could you do if you like? Let's say interest rates right now for what you were looking for were 4%. Okay? What could you do? Your downside risk in this circumstance, your downside risk is that interest rates increase. That's your downside risk. Right now they're 4%, and you like 4%. 4% is good. So if you're willing to lock in a 4% rate for better or worse, for better or worse, that's the key with futures. You're locking in that rate for better or worse. Option contracts, you have the option not to use it if you don't want to. If there's a better alternative than using the option, than exercising the option. If there's a better alternative than exercising the option, you don't exercise your option. But with futures, you lock in those prices for better or worse. In this case, you lock in a yield of 4% for better or worse. So now, how's it happen? Well, if you're okay with 4%, and you recognize that rates could fall to 3% if you just wait. On the other hand, rates could rise to 5 or 6% if you wait. So you have to decide first step that 4% is something that you're okay with and you're willing to lock in for better or worse. And so what you could do is, let me see, you get hurt. Interest rates rising implies pain for you, right? So you need something that will provide you with some benefit if interest rates rise. So, interest rates rise, question mark, how could you benefit from that? Well, let me see. When interest rates rise, the implication is the price of bonds, so I'll do price bond, fall. Okay. Well, there's a cost of carry relationship between the futures contract price for a treasury security and the actual spot treasury security price. So, if interest rates rise, bond prices will fall, and that implies futures contract prices for bonds will also fall. Okay, well, you're probably with me now. You're thinking, okay, so what we could do in our circumstance, where we're going to borrow money in 6 or 12 months at a rate of 4%, which we could lock in now if we wanted to, and if we decide we're okay with doing that, then what we would do is take a short position. So here's our great conclusion. Take a short position in some interest rate futures contract. Okay, short position. Because then, if interest rates do rise, okay, so if interest rates rise, then price of bonds will fall, and price of futures let me just erase that. Excuse me. And futures contract prices of bonds will also fall. And that means you could close your position. You could close, in quotes, your position by buying back the bonds at a lower price. So you would effectively have sold high and then bought low later on. That's if interest rates do rise. But we don't want to get too happy about this, because the fact that we sold high at some price when interest rates were 4%, and then interest rates went higher and bond prices went lower, so we took a long position in the futures contract to turn off that hedge. But we're also going to be stuck with higher interest rates when we borrow the money to fund the project 6 or 12 months down the road. So this hedge is just going to help us in that we will have a profit here on our futures position that can be used to offset the higher interest costs. So again, we will profit on our short interest rate futures position if interest rates rise. However, we will be required to pay a higher interest rate R on our borrowed funds in 6 to 12 months. So my big point, so it's just a hedge. So it's just a hedge. We don't want to get too happy. And again, we will lock in a 4% rate. Now, the size of the position we take in interest rate futures, the size of our short position, will determine how large our profit is and how much of the higher interest expenses that we will later pay will be offset. Okay, so that's another thing you have to keep in mind, that the size of your futures position will determine how much of a profit you have in your futures trades, and you have to decide how much risk you're willing to take with that, keeping in mind the higher interest expense that you'll incur if rates in fact do rise. So that's our first example. So a second example, how we use futures to help us do things financial. Imagine that you have just been notified that you're going to receive a lot of money. Excuse me. Maybe it's a lottery payout. Maybe a relative has passed on and left you in their will. Whatever. Let's suppose in 6 months you're going to get $5 million. And you figure that's enough, you're happy with it, you don't want to gamble with it. You would just like to maintain the purchasing power of this $5 million. Perhaps that's what you decide. And so you're not going to get the money for 6 months. So your downside risk would be if interest rates fall. So here, in this example, downside risk is associated with R falls. Interesting. Interest rates fall, That means, when I get my money, I'll earn less interest. Well, what you could then do, you're probably seeing it, is right now, 6 months before you get your money, you could take a long position. Okay, you open a long position in an interest rate futures contract, whichever one you want. There's short maturity T-bills and longer maturity T-bonds, and you have to decide, you have to engineer that on your own. But if you open a long position in an interest rate futures contract, you'll be doing okay, because if interest rates fall, the implication is the price of bonds will rise. And since there's a cost of carry relationship between the future, a treasury bond futures price and the price of the cash treasury bond, then this also implies that the price of a futures contract on bonds will also rise. Okay? And since you have a long position and the price of the futures contract rises, you'll be able to sell or take a short position in the futures contracts later to effectively close your position. And then the difference in the settlement, the difference in the prices you've locked in on the first the buy then the sell is your profit. And that profit you earn can be used to offset the lower interest income you'd receive into the future as a consequence of interest rates falling, if indeed that does happen. If indeed that does happen. And again, the number of contracts that you take a long position in will determine how much of a profit you'll have, and therefore the size of that profit will be able to offset a certain number of years or months or whatever worth of interest income that you're not getting if interest rates fall, that you would have gotten if interest rates had not fallen. And now, of course, let's just think through what happens. What if, in this case, interest rates don't fall, but they rise? Oh boy, interest rates rise. Well, if interest rates rise, in this example, you're not going to be happy. The implication is you're not very happy, because had you done nothing, had you chosen to not hedge, you would just have been able to enjoy higher interest rates. But because you hedged, you locked in that interest rate effectively because of your hedging activities. Now, the precision of the gain on the actual investment that you make when you get your money and the loss that you incur in your futures position depends upon how big of a futures position you took. And you can engineer that on your own. But just understand, you have locked in that interest rate for better or worse. And that's all I have. Thanks for watching.